Hello, this is Eric Boyce, the CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for January 17th of 2022. Please see our disclaimer for important information. Well, it's good to be back with you again after a several week hiatus. We have the end of the year and things generally do slow down around that time. And I was also out on personal vacation for a couple of weeks with my family. Enjoyed the time away, but glad to be back in the saddle here in 2022. And we'll kind of pick things right back up. So here's our high frequency data chart from our friends up at First Trust in Chicago. And without question, over the last month, we've seen this transition from, the Delta variant to Omicron, and Omicron is now the dominant strain out there, and it's highly infectious. And even though it doesn't have the same type of virulent punch that Delta did in terms of inspiring hospitalizations, we got a little chart on that. But it is impacting the data near term. Obviously, we went through the holiday season, typically a high traffic period. And so you can see in the change versus 2019 and change month over month in some of these travel categories, hotel occupancy versus 2019 down 12%, TSA checkpoint data now down about 25%. Month over month changes, you can see, are red in those categories. And so even though we're kind of migrating out of the peak holiday travel season, you can still see the impact. We were closing that gap on some of these metrics. Open table restaurant industry data now down 19%. That had narrowed to maybe around 14-15%. So we've seen a little step back, I guess I should say, in terms of the data. Now the labor market continues to really improve and in fact tighten. Now we have seen employment cost numbers kind of abate somewhat, but the cost pressures are still there. But really in this chart, you can see here staffing, labor, are really the bright spot here. All right, we've got several charts that kind of support that high frequency data. You can see TSA checkpoint data, and we're beginning to show in that I'll call it an aqua colored line here for 2022. But 2021 is in the dark blue, and then 2019 is in the gray. And so 2020, obviously the anomaly because of the pandemic, but you look at the comparisons in all these categories: TSA checkpoint, global commercial flights, a supply of motor gasoline that in that particular metric have really narrowed relative to 2019. And hotel occupancy now looking a lot more like it did before the pandemic, although we have taken a little bit of a down tick as we saw in the data in the last slide. But you can see that in most of these categories, you can see a narrowing of the gap between 2019 and where we are right now. And once we get past Omicron, I think you'll see further tightening in those particular categories. All right, quick look at the virus itself. We haven't shown this a whole lot over the last several months because we saw that Delta wave rolling over. Now we see Omicron. Suffice it to say, reported cases are going through the roof. I mean, higher than, frankly, anything that we've ever seen. And we're probably missing, 4 out of 5 cases that aren't being reported because maybe people are not symptomatic, whatever the case is. But, in the bottom chart, I think this is really important. Even though we're seeing a really strong aggregate increase in the number of reported cases, the hospitalization and especially the fatality rate continues to fall. You can see hospitalizations in that upper chart, daily deaths in that upper chart, really kind of almost flatlining, maybe a slight uptick, but that's only driven because of the sheer number of cases that are being reported. But it's not dovetailing with the number of cases being reported, meaning that this strain is not nearly as deadly as Delta was and the strains before it, Alpha, etc. Now we'll go ahead and transition into some of the economic data. We've got some inflation data right now. We've got University of Michigan consumer sentiment. These numbers, both when you look at it from a consumer sentiment as well as current situation, current conditions, as well as future expectations, all of those metrics in the last data reading of this particular data series were below expectations. And right here you see 68.8. You can see kind of linearly what's happened here in the latter part of 2021 into 2022. And you can just see as this whole virus thing kind of wears itself on, you get these subsequent waves. And then right now we're dealing with an issue without question where workers are getting sick. You hear the airlines having to cancel flights because pilots now have the virus. And so, big chunks of, workforces are being impacted because they're out. And, like essentially with more or less kind of like a mild to medium flu type symptoms, but they're out of work. And so it's, you've got a lot of businesses that are struggling to keep people, as I call butts in seats here. And it's kind of weighing on consumer sentiment as well, because things may be a little bit hard to find. Businesses may be operating at limited capacity or limited hours. But you can just see where this whole thing is kind of weighing on consumer sentiment a little bit. All right, this is food retail sales. So this is like food and dining, and we had a negative 0.8% monthly change number, and we haven't seen that since really the beginning of last year. You can see that we had this huge downtick, the huge recovery, and then we kind of bounced around a little bit, but on balance, very positive. But just because of what I've been describing over the last couple of minutes with Omicron and all of these other issues that are attendant to that, we did see a negative retail sales in the food service and dining area. So here is a chart on the Baltic Dry Index, and this is an indicator of what seaborne freight costs look like. Just put it in those terms. Freight that travels by sea. And this represents a cost index of what that is. And you can see that we peaked in the September period. It remained much higher than trend through the end of the year. Good news is we see that kind of attenuating a little bit. So we're down from the peak about 62%, which is pretty astounding when you think about it. But we still have a little ways to go to get to a more normalized environment. I do think we will get there, but it'll continue to take some time because, as I said, the Omicron issues are obviously not just affecting U.S., but overseas manufacturers, particularly in Asia, where they're doing really some hard lockdowns in some areas. And so I think the supply chain choke points, maybe the solution to that gets pushed out a little bit because of the current situation, but also that these freight rates remain a little bit higher, in part because of that, and people that are struggling to find ships for product so that they can replenish their stocks and the shelves at the retail level. Small Business Optimism Index. So we looked at consumer sentiment before, and I was describing how this relationship between what businesses are seeing and what consumers are thinking, and there is some correlation to that. So this represents two different data series. The first one in blue represents their optimism. So by nature, small businesses have been optimistic coming out of the pandemic. Labor is a big bugaboo for them still, but overall they're pretty optimistic. Now when they kind of look ahead in this kind of this amber line on what the outlook is for business conditions, now that's a different story. that continues to be negative, and this really reflects kind of the frustration that people are having in the labor market of finding people. That's still a problem. Like I said, the employment costs are still higher. They're not rising at the same rate that they were a few months ago, but labor is still tight. Inventories are still low. I think this is kind of another read through on this, is that the ability to sell is constrained by the amount of product that you have available for sale in a lot of cases. And since this is a pretty broad swath of small businesses that are being surveyed here, you can just tell that whether it's product or labor, that it's still a problem for small business. We'll talk about inflation now, and first things first, we'll talk about producer prices, and here's the core PPI year over year. We know that last year the consumer price inflation or consumer price index CPI inflation was 7%. Core PPI on the producer side, and this is stripping out essentially food related and energy related items within the production channel, and it's still up 8%. So this situation has certainly not gone away. Obviously it's still impacting freight prices, and we're still likely to have this persist because of labor outages due to the coronavirus and shutdowns or curtailments of production in plants overseas, so on and so forth. I mean, it's still an issue. However, the silver lining on this is if you look at the right-hand side, you see selling prices and goods across the supply chain. And if you look at the green area, which is unprocessed, these are raw materials. And then processed would be kind of intermediate stage of production, and then finished would obviously be finished goods. And you can see prices all along that particular production chain in October and November were positive on a month-over-month basis, and particularly October was particularly high on the raw material side. Ironically, in December now we're getting this data that the prices were actually down. And so even though this PPI index, the core index, is higher, we have seen some recent data which would tend to suggest that maybe that rate of increase in core prices, or maybe even the aggregate level of overall year-over-year growth in prices, may slow down here a little bit in the next month or so. So we'll turn our attention to CPI, and I've got some charts on this. Some of this is fairly intuitive and perhaps even just outright obvious that you've seen this in your own household, you've seen this in your own circle of influence. But energy prices are high. This is a composition and breakdown of what headline CPI looks like. So obviously we're ending the year at a fairly high level, 7%-ish, and you can see vehicle-related impulses are very strong within the price basket. Pandemic-affected services, which were maybe a little bit stronger in influence earlier in the year, they still persist. Airfare, hotels, prices there continue to be higher. And then, as I mentioned, energy, and then other core prices are continuing to go up as well. But you see in this chart really what the derivation is, and you can really glean from this that going back to March, when we really started to see this outsized inflation number, that the texture of what's causing inflation really hasn't changed that much. Well, digging into some of these components, some of the areas that we've been talking about consistently over the last several months, we figure we go ahead and talk about here. So rent on a core level represents about a third of the core CPI index. You can see here, obviously rents went down in terms of their year-over-year gain level, but they picked back up, not necessarily to where they have been in terms of a percentage basis, dating back to maybe call it 2015 to 2019, but they are rising. That's no surprise. We knew it was in process. We knew that rents tend to lag home prices by a matter of months, and that all of that stuff's playing out right now. You see owner's equivalent rent, which is actually the rental component that is embedded in the consumer price index at the core level. And then on the right-hand side, you see new vehicles, used vehicles, no surprise there. We saw that in the composition chart on that last slide, where car prices, and it just has an impact because it's such a high dollar ticket item. So it continues to be an issue. Food away from home, we saw those sales be down, be negative for the first time in many months. I'm not going to say that one reason is because of prices at restaurants being higher, but this is just a function, if you look at this chart on the left, of what's going on in the service industry, where you've got labor prices that are moving higher, you've got input prices, food especially. The food costs, beef, poultry, dairy, all of these things are higher year over year. And so you can see that the consumer price basket allocated to this particular component is up. And it's reflective of the fact that a lot of these businesses are able to push these costs onto consumers. On the other hand, you see medical care. Even though the variability of these types of costs in the medical sector have really begun to vary widely over the last 4 or 5 years, you can see that they are below where they are, although they're pretty much in a trend that we've witnessed basically dating back to 2005. I thought this was really interesting. So this is a chart from Adobe Analytics, a year-over-year change in prices for online goods. And we've always thought of online or e-commerce as the big disruptor, right? The big disruptor that's going to reduce cost in the delivery chain for retail sales, and that's definitely been the case. So online retailing, e-commerce is taking cost out. You can see consistent declines in year-over-year online prices, except during the pandemic. And this is reflective of the fact that demand completely outstripped supply at a time where we had plant shutdowns and whatnot because of the virus. And now we are seeing quite the opposite, very consistent year-over-year positive increases in prices across really the entire e-commerce spectrum. Now we'll switch into talking about the consumer. So we've talked about this data a lot. In the bars, you've got the monthly savings amounts, and then you have the cumulative excess savings in that I'll call it kind of this orange, amber-ish shaded area. And we are leveling out about 2.7 trillion. Now that's good in the sense that there's a lot of pent-up monetary support for continued consumption, continued consumer spending, and I think that certainly bodes well when we get past the pandemic. And there is a lot more interest in people getting out. They're going to take the trips that were being pushed out or outright canceled because of Omicron or whatever. That you are going to see that pent up spending. But as you can see here, the amount of monthly savings, which was influenced a lot by transfer payments, basically government payments, stimulus checks, child credits that have now expired unless Congress decides to renew those, and there's no visibility for that. But you can see here that that monthly savings was really impacted by those transfer payments, and those have largely gone away. And so we're really now back to trend line in terms of monthly savings. And so what that means is that this cumulative excess savings is probably going to flatten out here around this 2.7 trillion level. Again, positive in the sense that it's a lot of dry powder for spending down the road. We'll talk about the market now for a little bit, and I thought this was really interesting. This is from Liz Ann Saunders at Charles Schwab, and what's really important here, and this was the case, frankly, last year, even though the index was up a lot, there were a lot of constituent members of the index that really had some pretty significant drawdowns. And as you can see here, as of the 12th, which is, again, it's dated by a few days here, but it's current enough that these conclusions are absolutely apt here. Year-to-date return, we're slightly down on all the indices. We've had a little bit of a soft environment out of the starting blocks here in 2022. Index drawdowns, have been anywhere between 3 and 6%. Again, 5% is maybe call it a reversal, a sell-off. 10% is where you get a real correction. And of course, you've got really a minority of the index members that have had a positive year return, understanding that the index itself is negative. But when you look at the data on the right-hand side of this, percentage of members with at least a 10% drawdown. This is an outright correction, price correction when you get below 10%. You can see that in the S&P, about 15%, so a minority. But when you get down into the NASDAQ and Russell 2000, you see a much greater percentage of that index have had pretty significant drawdowns year to date. And the average member drawdown from the high has been, again, 5 to 10%. So such is the case, when you're looking at the stock market, that, what you see in a broad market doesn't really tell the story of what's going on in all of these various factions and components. And we've got some charts here that will kind of illuminate a little bit of what's going on inside the market itself. So before we really get into the components, let's talk about earnings and yield right now. And so, there's two different kinds of yield when you talk about the stock market. There's a dividend yield, which is essentially dividends that are paid divided by the index itself, and that's your dividend yield on the index. And then there's something else, another yield, which is the earnings yield. And this is the earnings of the index collectively divided by the level of the index itself. And in this case, we're looking at real earnings yield. So this is the earnings yield of the index. Again, earnings of all of the index members divided by the value of the index minus the inflation rate, which we know is higher right now. And so I just want to be clear that this is the real earnings yield, which subtracts out inflation. Obviously, we've had bouts of high inflation in the past, and when you think about, after the OPEC embargo, you look at this chart, which goes back a long, long way, well more than 50 years. If you go back to that 70 to 74 period, we had we had a negative earnings yield. And then you go back into kind of the high inflation period in the late 70s, early 80s, before Paul Volcker really spiked interest rates to try to head off inflation. You can see that we've had negative earnings yield moments in time, but we've never been this negative. We're at a really unusual period here because the earnings yield, basically is impacted by this outsized inflation that we have. So we know the earnings have been going up. We've had a really strong response in earnings, but we've also had a really strong response in price in the index. And so when you have that, you really don't change the earnings yield that much if both are moving in the same direction at the same magnitude. But then when you subtract out this really big inflation that we've had lately, you get to a point that we've never been at this level of negative real earnings yield before. So when you think about valuation, most people talk about earnings. This is something that I found in some Schwab research, which kind of helps to corroborate this valuation argument. And this is a percentage of the S&P 500 with a price to sales ratio above 10. And again, this is not a really high number when you think about it. It's about 15% of the index. But you can see that a price to sales ratio above 10 is representative of a fairly high growth stock. And usually you just don't see that, particularly when you talk about staples, like Kimberly-Clark, and you talk about more manufacturing companies and kind of these static, kind of steady cash flow companies. I mean, you really hardly ever see price to sales above 2 to 3 to 4%, hardly. But in this case, we're seeing a pretty dramatic rise, and it's a multi-year trend too, a dramatic rise of the members in the index with a pretty high price to sales ratio. So this goes back to kind of the comments about real earnings yield. So when you look at overall and average earnings across all these different sectors, these are some of the different sectors in the index: information technology, financial, education, health, manufacturing, construction, so on and so forth. And then you overlay that with the level of inflation that we had last year, which is 7%, and that's in that pink line. What you find here is that you have negative real earnings, and you have earnings in these sectors that are not meeting these particular levels within the individual sectors of the index. So in talking about the components here, one thing is playing out for sure here in the early part of the new year is that value is reasserting itself. We've seen growth really outperform at periods, and this consistent growth over value, but value is really kind of taking the horns back. Now, we did see this a little bit at a couple points last year, but we've really seen a fairly strong rotation into value here in the early going, and that's one reason why we do have an allocation to value. Now, on the right-hand side, we've got what I would consider to be, the S&P 500 relative to kind of the high growth tech stocks, if you will. Now, this is non-profitable, so these are not high quality companies, but they're in some cases more speculative growth companies, and not the Google necessarily, not Apple, but these are other kind of like non-profitable technology companies. Now, these were actually the darlings, and the oddity was at many points last year that the non-profitable companies were performing better than the high cash flow companies were, but that's certainly not the case here over the last few months. Shifting a little bit into fixed income. So, we have seen the rise in Treasury yields over the last month or so, and with that comes a rise in mortgage rates. And so what happens when that happens, or when that occurs, I should say, is that mortgage rates jump, you have less of an interest in refinancing, refi drops, and we've seen a lot of consumption driven off of cash out refinancing, particularly amongst people that are able, by virtue of their credit rating and credit level, to be able to do that. And we've seen a lot of consumption driven by that. And so now we have this expected rise in mortgage rates, which is dovetails with the 10-year U.S. Treasury. Here is the chart for the 10-year Treasury real rate. Again, we looked at real earnings a few slides ago. Now this is on the interest rate side. So these are essentially the 10-year U.S. Treasury yields minus inflation. And as you can see here, with rates moving higher, the real negative yield is actually going down. And so this is kind of an inverted scale. So, the lower you go on this chart, the more negative your real yield is on the U.S. 10-year Treasury. And so with it moving higher, what we're seeing essentially is a reversal of the trends that we've had over quite a few months now, where we've had significantly negative real yields, and those, because interest rates are moving higher, we're seeing those be less negative. So as we look across the globe, one thing that we've talked about really over the last several years, and all of the stimulus out there, is that this vast amount of debt, sovereign debt, and corporate debt that has negative yields to it. I mean, you could buy, Japanese yen denominated bonds. You could buy, German boons that are that have negative. Essentially, you're paying for the convenience of investing money for a period of time. And at one point, as you can see here, back in December of 2020, there was almost $18 trillion of negative yielding debt across the globe. And with interest rates moving higher across the globe, not just here in the US, what we're seeing is that number is coming down. And so we haven't been at this level, just under $10 trillion of negative yielding debt around the world. We haven't been at this level essentially since, call it right, around the early part of 2020. So there's more speculation now. Since the last time we got together, we've had some Fed testimony, Fed Chairman Powell. I think there's a really strong consensus that we're going to get a 25 basis point or 0.25% increase in short-term rates at the March meeting, and that we're going to get another 25 basis points here coming up in the May meeting. And so again, that is going to increase our short-term interest rates by about 0.5%, which should push the longer-term rates a little bit higher. Now we'll get into some thematic things, just reading some research from Global X this week, and I thought it was really interesting. And there's some trends that are really taking hold that I think we all realize, but the magnitude of which may be less understood. So looking at the digital economy, and you can see here in this slide, without getting really into the weeds, but you've got e-commerce, fintech, financial technology, cybersecurity, video games, social media, and then cloud computing. All of these various subcomponents in here represent the digital economy landscape. And so I just show this slide because the next couple of slides are going to be driven by this, but some really good forward-looking analysis from Global X here in a piece, about 125-page piece here. But you can see that these are the areas of the digital ecosystem, and then in the next slide we'll see some of these trends that are evolving. So we see the digital economy's footprint, and when you think about all of the components of our economy, and this may be a little hard to read on the right-hand side, but all of the various influences on our economic level of economic output, basically our size of our economy. Digital economy is not insignificant at 10%. See, manufacturing still represents about 10%. You've got government spending about 12%, and you've got real estate, again, homesteads, commercial real estate, the value of all of that, and that's probably close to 13.5% to 14%. But the digital economy as a percent of the overall economy has moved up from kind of the high 7% from 2005 to now about almost 10% of our economy, and it's going to continue to increase over time. And so when you think about the impact on investments, and you think about the impact on economic growth too, you have to consider this, because you're going to have more companies in the index whose business models are going to be predicated on the evolution of the digital economy. And so those companies tend to take on higher multiples. They tend to be higher growth. I think the texture of what the index looks like is going to change over time. And what does that mean for like say valuations? You're still going to have influence from manufacturing, from consumer staples, and utilities and things like that. But I do think because of the rise and the concentration of the digital economy in our overall economic growth, that you're going to see more influence from companies, publicly traded companies that have these types of more technology characteristics to them in terms of higher multiples, higher growth rates, and potentially more volatility. Well, we've talked a lot about cryptocurrency. There is some really good data in this Global X research, but what I thought was interesting here is you look at the life cycle of cryptocurrency, and we're still very much in an early adopter phase. I don't think that's a surprise to anybody, but when you look at the life cycle, they're looking for a size of cryptocurrency now that's going to eventually be about 47 trillion. And they're surmising that essentially over the next 8 to 9 years, the size of the cryptocurrency market is going to move from $3 to $10 trillion. So when you think about the influence of crypto and all of that on the overall economy, on the payment mechanism, this I think does consider the fact that a lot of central banks are going to likely issue their own cryptocurrencies, and those will have much more legitimacy in terms of a medium of exchange in commerce than a lot of the Bitcoins, Ethereums, Lunas, all of that do now. But again, you see here that the size in the market is going to increase essentially more than threefold here in just a handful of years. The other thing I thought was interesting, robotics too, looking at the size of the robotic market. We're still in an early adopter phase. I mean, a lot's going to happen here in the next 10 to 15 years. And this report is kind of, foreshadowing some of these areas that are really taking off. And robotics is going to help in the manufacturing. We see it already in retail, and Amazon's use of robotics in terms of moving packages, and you're going to see it in a lot of different type of warehouse and distribution environments really begin to take hold. You can see here that kind of not unlike cryptocurrencies, but not necessarily to the same degree. You're going to see over the next 8 to 9 years a really strong growth rate in robotics. And electronic vehicles, we talk about this a lot, and obviously here in Central Texas we have Tesla and their Cybertruck development facility going in, and we know that EV is taking hold, and there's mileage mandates that are coming into play against the backdrop of this more broad ESG move by companies. But you can see here, again, 8 to 9 years, strong growth rate in electronic vehicles. And looks like the penetration rate, could be 36% here with a size of market that goes from essentially 120 billion to 1.4 trillion dollars on its way to its ultimate level of 3.8 trillion by this analysis. But the other thing that sets EVs apart is we're expected to make more traction in getting into more of a mainstream adoption of EVs than we are, say, robotics or even cryptocurrencies over the next 8 to 9 years. And renewables. This really goes to the heart of some of the things that are out there legislatively, the mandates for certain types of emissions, the mandates for amount of energy coming from renewable sources, the amount of mileage enhancements for vehicles and things like that. And what's really clear, and this isn't the first time I've heard this, there was a Federal Reserve presentation related to energy that talked a lot about this and the types of things, the pressures on what needs to happen for us to hit these numbers, essentially 88%, by 2050. That's a huge jump. And you can see the track that we've laid to date does not lend itself at all to being able to get there. So there's a tectonic shift in a lot of things that will have to take place for us to be able to hit these targets on renewable energy. And lastly, I thought I'd end on this one. I thought it was pretty interesting. So the trend, rural versus urban, and what we've known, and the inflection here in terms of the global population density that lived in rural areas versus urban. That inflection point took place really about a decade ago, maybe a little bit more than that. And you see this increasing concentration of people or migration, if you will, moving to the urban cores. And so, I think about this, wearing my hat as a city councilman here in the city of Cedar Park. But more broadly speaking, all municipalities are going to have to face this. You've got this migration into these urban core areas, and it's going to tax infrastructure. It's going to place a lot of pressure to forward plan to make sure that you have water resources, that you have all of the other things that are attendant to not only growing population, but in growing density as well. So as you can see by this chart, as it looks out to 2050, that trend certainly accelerates between now and then. Well, that's all I've got this week. Hope you've enjoyed the chart presentation. On behalf of the entire team at BKA, wish you a very good week, and we will be back to you next week with some more charts and insight. Take care. Bye-bye.